What's up, Wagwan, and big up on yourself. It's your boy Illuminati, linking up for Crypto Caribbean TV and Crypto Today in this day of our Lord Satoshi, 2nd February 2023. So today we're talking about the Federal Reserve Bank, or the Fed as they are more popularly called, and how they control the supply of money in the US and in any other economy that is attached to the US economy actually. They do this basically by increasing and decreasing the size of their balance sheet. Specifically, the currency in circulation plus the deposit balances of banks and other financial institutions held with the Federal Reserve Bank. Now, to be clear, the Federal Reserve has essentially complete control over the size of the monetary base. But before we get into that, as always, we have to do some house cleaning. A reminder that nothing that I share in this video or any other video should be misconstrued as financial advice. I am not a financial advisor. Right, guys? Remember always the ICE rule. It's all about information, conversation, and education. So, with that said, with that house cleaning done, let's get straight into it. So the Federal Reserve Bank uses three main tools when managing the monetary base. They do so using reserve requirements for banks, the discount rate, as well as via market operations. Now, the reserve requirements or reserve ratio is the percentage of reserves a bank is required to hold against its deposits. I'll do another video later on about fractional reserve banking to clarify more about that. But basically, a decrease in the ratio allows banks to lend more, thus increasing the money supply, whilst increase in the ratio basically has the opposite effect, right? Now, the discount rate is the interest rate the Fed charges commercial banks that need to borrow additional reserves. The Fed sets this rate and not actually a market rate. But much of the importance of the discount rate stems from the fact that it signals, if it's low, that the Fed wants to encourage spending, and if it's high, that the Fed actually wants to discourage spending. Now, while the discount rate is the rate at which banks can borrow from the Federal Reserve, it shouldn't be confused with the federal funds rate, which is the rate at which banks can borrow from one another. Now, the federal funds rate is a target interest rate by which the Federal Open Market Committee, or the FOMC, basically determine market conditions, right? It basically determines how commercial banks can borrow from each other, when they can, and what that lending looks like. But this is not about long-term lending or long-term borrowing. This is about overnight borrowing to maintain reserve balances or reserve requirements. The FOMC, which is basically the policy-making body of the Federal Reserve System, meets 8 times a year to set the target federal funds rate, which is basically part of their monetary policy. So the committee cannot really force banks to charge the exact federal funds rate. However, the FOMC sets a target rate mainly as a guidepost for the banks. The actual interest rate to be charged by any lending institution is basically determined through the negotiations between that lending institution and the other bank that they intend to lend to. Now, the rate will usually influence short-term interest rates indirectly for everything from home and auto loans to your credit card interest rates. And this is basically because lenders who usually set their rates based on their prime lending rate will typically also be influenced by the federal funds rate. So it's basically a whole domino effect. So for those who don't know what the prime lending rate is, it's basically the rate that banks would charge their best customers. So all the big boys, that's the rate they get. Now, after almost 3 years, last year March, the Fed for the first time approved a rate hike of 0.25% and basically signaled its intention to continue aggressively raising rates until they felt that inflation was suitably taken care of or suitably under control. Now that rate had remained, like I said, pretty much unchanged for the previous 3 years at around 0%. But why are we talking about this today specifically? Now, yesterday, the Fed again announced another 2.5% interest rate hike. It's 8 consecutive rate hike in less than a year. So moving from 0% or close to 0%, the range is now at around 4.5 to 4.75%. So we're seeing them continuing to aggressively try to deal with inflation, and their main tool in doing so is the federal funds rate. Now, this rate hike was pretty much expected by the markets. So immediately after the announcement, we saw global stock markets and even the crypto market rally on the news. We also saw some softening or weakening of the Dixie, but we'll talk a little bit more about that later this evening when we link up for the Crypto and Cognac podcast show. So here's what I want you guys to do. I want you all to grab your drinks and join me later, 7 p.m. right here live on YouTube, and we link up. Right, that's all I have for you right now, guys. As I always say, adoption is inevitable. Illuminati out. Bless.